Hello, fellow stock market traders. My name is Doug Campbell. I run a service called Right Way Options. But today I'm here to talk about something else. I've traded, just to give you a little bit of background about me, I've traded the market for more than 27 years. Now, 12 years of that, more than 12 years, I have been able to trade full time and support my family, put a couple kids through college from my trading. But I want you to also understand that that didn't come easily, that I learned a lot of lessons along the way. I made a lot of mistakes. And I was asked to create this video on what is the right stock option to buy. When you're looking at an option trade, if you've stepped over into that world of options, it is sometimes difficult to get really good information on doing it. So I'm going to give it to you from my perspective. This is obviously not the only way to trade options, but I can tell you this has been extremely effective for me, and it's a rule that I live and die by, or the rules that I live and die by when I'm buying an option. Okay, and there will be another video on options that you would want to sell. There's a big difference between those that you want to buy and those that you want to sell, and there's a difference in the rules. So we'll do that in a follow-up video. But for this one right now, I just wanted to focus on options that we want to buy and how we would set up that trade. What's the right one to buy? And of course, I'm always interested in efficiency in my trading, and I'm also very interested in putting the odds in my favor. That's where I want to be. That's what one of the reasons I trade options, other than the cash efficiency and the leverage, I wanted to get into trades that actually had better odds from the entry. So that's what we're going to talk just a little bit about today, and I'm going to go over a couple of my rules and how you can start utilizing this to improve your trading in options. So first off, there are so many choices when it comes to buying an option. And if you're new to trading, you look at an option chain and it is just overwhelming. There is just so much data there. A lot of people just look at it and run away scared because there's so much data there. Which one do I choose? And so that's what we're going to talk about today. Now, I'm a chart guy, okay? I live and die by my charts. And I don't even think about a trade unless the setup is there. So I just threw this chart up as an example here on Adobe. And by the way, yes, I do trade with charts like this. I call it a naked chart. I rarely use an indicator. If I do use an indicator, it's one or two indicators. I almost never use indicators. I use white background charts, black and white candles, so I can identify the price patterns easier. And I can tell you, once I cleaned up my charts, that's when I really started to make money in the market. But I identify this chart, and I've got this nice little wedge pattern forming here. Stock popped out and is looking pretty good. So on Adobe here, I think I want to make a trade. So I'm going to start planning my position, and this is extremely important. It's important on stock trading, on option trading, any kind of trading that you do. You need to have a plan. You need to think about the overall aspect of that trade. What are the details? Because the devil is definitely in the details if you're going to get a trade right. So in your planning, one of the first things you want to think about is trade duration. One of the things that makes options very difficult is that not only do you have to be right on direction, you have to be right on the timing. Options expire, and so you have to be right on the timing. So the first thing you want to think about is, if you find that trade and you want to think about using options for it, is how long do you think it will take for that expected move that you're looking for? How long will that take for that to be completed? Now, if you're a swing trader, a short-term trader, you may have a trade duration that's more like 7 to 10 days. Well, if you're a 7 to 10 day trader, you still cannot buy a 7 to 10 day option. What if that stock, and we've all done this, right? We see a setup, it's beautiful, we think that chart's just going to take off. Just like here in this Adobe chart, we just think, wow, that's a beautiful setup. This chart's just going to go to the moon. And then what happens? You buy the trade and it wanders around for a couple, 3 weeks. Doesn't really go anywhere. Just sits here and camps out. And if you buy too little time, you're going to end up losing money on the trade just simply because you didn't think about the move. And so what I usually tell people is that you want to make sure you're planning enough time in your trade. Don't get too short of time on this, because theta is always working against you. All right, so we want to plan enough time. I'll give you the rules that I use here in just a second. You also want to consider implied volatility. Now, implied volatility is extremely important because implied volatility goes to the pricing of those options. Very high implied volatility in an option can warn you that there may be an impending event about ready to occur, such as an earnings event or something like that. It can be a warning sign that something is coming up. But it's also a very good indication that if you're going to buy an option, you may be overpaying in extrinsic value. Remember, implied volatility only affects the extrinsic value of that option, the time value. Higher implied volatility means you pay up more for time. The person selling that option requires more premium simply because that higher volatility brings more risk to the trade. So they require more premium for that risk. So if you're overpaying, if you're not paying attention to the implied volatility, you could actually be overpaying in time or for time for that trade and putting yourself at a tremendous disadvantage right from the beginning. So always look at implied volatility. Now, I know the question that's popping in your head right now is, well, what's a good implied volatility? Now, when you look at an option chain, look at all of the options in the series, okay? All the different option months that are available. And look through those. If the standard implied volatility for all those monthly contracts is 20% and they stay in that range of 20%, then everything is copacetic. You're good to go. If the average implied volatility is 45% in all of those contracts, you're probably good to go with that trade. Just know that you will pay more. There's more volatility in that higher trade. That's normalized, though, in that chain when that volatility is a little bit higher, okay? But when you look at it in an option chain and all of a sudden you see that there's one at 175% implied volatility and it's normally in a 30 or 40% range, that's telling you that there's probably an event coming and you really need to investigate a little bit further, okay? Also, high implied volatility will almost always create wider bid-ask spreads. It's going to cost you more money in the bid-ask spread, so always pay attention to that implied volatility. The next thing I always take a look at is open interest. I am always wanting to make sure that I'm in a liquid trade. There's no sense getting into a leveraged trade where you have no liquidity. If there's not enough open interest there, you want to steer away from that trade. We all know this. There's a lot of option contracts out there. There's a lot of stocks that trade options. That does not mean that every stock that trades options, that those options are worthy of being traded. Make sure you're checking those details, okay? So that's your first step, is in your planning for those options. Take a look at that. Now, we all know that we have to be correct in time as well as direction if we're going to trade a directional option. So timing is very important. And with options, these are kind of some very simple rules that I use, okay? If I'm going to trade a directional trade, if I'm looking at that Adobe trade, I'm probably going to look at options that are going to be somewhere between about 65 and 90 days plus. I will say plus, more out. And the reason is because I might find a better deal in bid-ask spread and everything on an option that's further out. I've actually gone out more than 100 days more and paid only a dollar more per share. Have all that extra time because I checked. Make sure you're checking those option contracts, and I'll show you here on an option chain in just a little bit. But as a general rule, I look for 65 to 90 days in time on any directional trade, because I've done it, you've done it. If you've been in the market for any time at all, you can be absolutely sure that a stock is going to move, and then it just goes flat for a while. Remember, there's an old saying that stocks take the escalator up. It's slow, it grinds. It's rare, you don't always just get that big popping move, okay? They're more in a grinding mode when they go up, for the most part, unless you're trading highly volatile stocks, and I would tell you probably that's not working out very well for you. Now, on put options, and when I buy put options, I will go down to about 45 days and sometimes even a little bit less. And why would I do that? The reason is when a stock decides it's going to fall, it normally just gets busy and falls, right? It doesn't drag very long. The old saying, that the stocks take the escalator up. Well, they also say that they take the window going down. They jump out the window. And so when a stock falls, it normally gets busy and falls. So I will take a little bit shorter term in time on a put option if I'm buying a put option than I will on a call option. Okay? So I can have, a little bit more flexibility there, but usually it's 45 days or more. I will often be up in here in this time frame, even on a put option, to give myself more flexibility. There's another reason for doing that. If you happen to be right on the trade, just a little bit wrong in the timing, at least with these options, with a little bit more time, you have the flexibility to adjust. If you trade really, really short-term options. I'm not a big fan of weekly options unless you're using them to sell premium. But weekly options are just kind of, when you buy a weekly option, it's just kind of like walking up to a roulette wheel and betting on red and black. It's kind of 50-50. If you're right, you're right. If you're wrong, you're wrong. And there's really nothing you can do to adjust because it's over. The time eats you alive. So make sure you have enough time that you can adjust if necessary in the trade. So a good rule of thumb, just a real simple rule of thumb to use, is to plan at least 30 days more time in those options than what you believe the expected move to be. So if you believe the expected move is 2 to 3 weeks or something like that, you need to be looking into that 45, 50, 60, 65 day range to give you enough time to not be in a situation where theta is affecting your results. Okay? It's a big mistake a lot of amateurs make. They don't give themselves enough time. Okay? Make sure you plan for that. Okay, so here's an option chain. So where do you begin? Well, first off, here's what, and by the way, this is the Thinkorswim platform. I use Thinkorswim through TD Ameritrade. And in my opinion, it's the best option trading platform out there, hands down. But again, that's my opinion. Now, in this, you can see we have lots of different option series. We've got, everything here with, weeklies with only 4 days left to expiration to January 2019 options that have 500 days left to expiration. But look over here at the implied volatility. Implied volatility stays relatively normalized. We have one here that's at 30. Okay. And it's pretty normalized right in here. we kind of stay in a range. So there's nothing in here that's really warning me of a problem. No big issues here for me to worry about for an event that I might not have caught someplace else. And I also know that that implied volatility is not very high, so I'm probably going to get a pretty decent price on my trade. So here again, we're looking at these options. If I look at the Octobers here, only 46 days to expiration, I can rule those out right now. If I'm going to go long on this trade, I don't have enough time. So I'm going to have to start with the Novembers and move from there to find the trade, to find out if there's a trade for me on that stock. Okay? So we're going to talk a little bit about finding the sweet spot. Okay. And before we do that, before we get into some of those details, I want to jump right to an option chain, an active option chain. We're going to take a look at this option chain. So here's Adobe in that option chain. And I'm going to open up these November contracts right here. And I'm going to scroll down and take a look. Now, first thing you're going to notice, I need to change this. I didn't realize I had that on there. I want to put theta on my... Up here at the top, these are the call options over here. I have delta, gamma, theta, and I have open interest. Now, open interest is really important to me. I want to make sure that I have enough contracts being traded in here that I can trade this. Now, I will tell you right now, these contracts are just a little bit light. Okay. I could still do it depending on how big I wanted to trade it. And if you're an individual trader, you know, you could certainly, if you're a one contract trader, there's plenty of open interest in here to trade. Okay. But you want to make sure that there's plenty in here. Now, a rule of thumb that I use, and this is the very rock bottom rule of thumb, is there must be at least 10 times the amount of contracts that I am willing to trade, or I am going to trade, in open interest. And that is the rock bottom minimum. I normally would walk away from something that's only got 10 times. I want to have enough liquidity to be able to trade that. Now, we all know Adobe's a big company, good stock, always going to, you know, probably be traded. It's just this November contract is not being heavily traded here. So we have plenty of time. We got 74 days in the trade. So where is the sweet spot in here? Well, first, to understand the sweet spot, we need to understand a little bit about delta, gamma, theta. Okay. So delta, what does delta do? Well, delta tells us how fast an option price will move based on a $1 move of the stock. Okay. Everyone hopefully knows that. I'm not going to spend a lot of time here. I'm going to assume that you know a little bit about these. Okay. So and here's a common mistake, a really common mistake that new traders make, is they buy an out of the money option. They buy an out of the money option taking a directional trade. Now let's think about this in delta. What does delta also tell us besides how much a stock will move? How much an option price will move based on a $1 move of the stock? It also tells us the probability of that option being in the money at expiration. Okay, so this option right here, if we were to choose this option only has a 29% probability of making it into the money. What value does an option have at expiration if it's not in the money? It has zero value. Zero value. All options expire at expiration. So a big mistake that happens a lot is folks buy options that are out of the money. And we can prove that right here in the Thinkorswim platform. And let me show you. I'm going to put extrinsic value on here, and I'm going to put intrinsic value on here. Let's see. There we go. Okay, so the extrinsic value or extrinsic value of this option that we were looking at is what? $2.71. Now, I don't know why. Oh, it's because of the bid-ask spread. But what it's telling us is that there's no intrinsic value. There's no value in this option if this option does not make it to expiration in the money. Now, this option can definitely move up in price. There's no doubt about it. Okay, but what you're paying for here is all time. Now imagine buying this option thinking that the stock is going to just quickly move up, and it just lays there for 2 or 3 weeks. It doesn't do much of anything. You are in a painful position here because theta is decaying this option away. You're losing money. Even though the stock hasn't fallen, it's nothing bad there. You're losing money because theta is the only value that you have in this option. Now, if you look at the in the money options, notice that a big price, the bigger price of the option is the intrinsic value. That's the actual value in the option. If you were to sell that contract, that is what you intrinsically have in value of that option. The extrinsic value is more than it is down here, but what I'm going to show you here is theta has less effect on this option than it does on this option. Theta has all the control. Implied volatility has all the control with these options. Remember, implied volatility only affects extrinsic value. It does not affect the intrinsic value of an option. Okay, so let's go back here to my gamma and my open interest. Okay, so where do we want to be when it comes to buying an option? Well, my rule, the rule that I teach and everything is if I'm going to go directionally long in this trade, I'm going to be looking for any option that has a delta somewhere between 70 and 80. And why 70 and 80? Okay, I'm looking for that sweet spot. Okay, so notice right here with this 73 delta option. Okay, notice that we have a gamma of 2. Now, we have a gamma of 2 because of the length of time in this. As you go closer and closer to expiration, gamma around the at-the-money options is higher. We have more sensitivity to gamma at the money than we do in the money. Okay, so we want to avoid that. So here's a good look at that. I'm just going to go to the Septembers, roll down here, and show you what's going on. The at-the-money option has 8.08 in gamma. Notice that I need to change that one to theta. There we go. It has minus 7 cents in theta. Theta is decaying the at-the-money options faster than it is the in-the-money options. Notice that you have less sensitivity to gamma and less sensitivity to theta with in-the-money options. Okay. As you go out of the money, notice the further out of the money you go, well, you have almost no probability of success here. So your gamma and your theta are also less sensitive than anything that's right here at the money. So another major mistake people will make, or new traders will make, is they will buy the at-the-money option. And all it takes is just a little small move, and all of a sudden that option is out of the money, and it's hugely affected by gamma and theta. So we want to avoid that by going to the in-the-money options. All right, so we're giving ourselves enough time, and we're going to look at an option. So I can tell you right now that this option right here, the 73 delta option, is probably where I would go. Now, is there something here that would say that would prevent me from buying the 64 delta? No, not necessarily. I will sometimes cheat down. Depending on the length of time in the trade, I might do a 67, 68. Rarely would I go down to 64. And let's think about why. Okay. If I'm right on direction, if I've done the technical analysis correctly, let me ask you this question. If you have done your technical analysis correctly and you believe this stock is going to move up, would you rather collect 64 cents for that $1 move or 73 cents for that $1 move? See, I want the bigger move, but I don't want to pay up too much. If I pay clear up in here, this 87 delta, if I get clear up in here, it's not like that it's bad. It's just I'm paying so much, I'm giving up a little bit of my leverage. I'm going to collect 87 cents for a dollar move, but I might be overpaying for my intrinsic value here. Okay, so that somewhere between that 70 and 80 is that sweet spot. So these two options right here would be where I would want to find my trade. Now I have more open interest here. So if I were choosing between these two, I'm going to be here without question. Going to be right here. All right, that's going to be my trade. So I've got enough time. Now let's look at the put side. If I were thinking that it was going to fall, I'm going to do the same thing, but look over here for open interest. Open interest kind of says no one is very optimistic that the stock is going to go down here. Almost no one trading this inside the money down here. They're speculating out here, and this is probably mostly spread traders out here that are spread trading, giving a high limit, saying it probably won't go up there. This down here, in fact, these are so evenly matched, I'd almost say that there's a really big trader or a single institution spread trading this. But there's nothing here suggesting that this wants to go down. I don't have enough open interest, so I cannot trade this. But if there were open interest over here, again, I'm going to be looking at that 70 to 80 delta on that trade. Okay, that's where I'm going to be. So now we know that if we're up in here, first we're going to have a trade that this trade has a 70% probability of success based on how the options are traded. The mathematics say, the pricing model, it says, this one has a 73% chance of finishing in the money. Doesn't mean that you can't lose money on it. You can. But it has a higher probability of success. If you buy this one, you've got a 53% chance of this option being in the money. Which do you want? Second thing, do you want an option that'll pay you 53 cents for every dollar move, or something that will pay you closer to 70 cents? So I look at this. It's really simple. I look at this trade, something in between here gives me better than a 70% probability of success. And that is the zone that I want to be in here on a trade. Okay. So consider your gamma, less sensitivity to gamma, less sensitivity to theta in that trade. So let's go back and look here, finding that sweet spot in those options. Delta, somewhere between about 70 and 80. So you're going to have that higher probability of finishing in the money. Now, that higher probability means that if you're wrong and the stock moves against you, because you're in the money, you don't have as much sensitivity to gamma, meaning that it gives you more time to adjust. You're not going to lose as much money. If you're in an option that's at 50 deltas, it's going to have a higher gamma. When it falls out of the money, it's going to move more percentage-wise away from you. You're going to lose more money. So up in here, you have a little bit more time to adjust. Not a tremendous amount of time. You just have a little bit more time to adjust or modify your trade. Okay? You get the opportunity to have good leverage without overpaying in that 70 to 80 range. They're less sensitive to gamma. Again, gives you that more time to adjust. They're less sensitive to theta, lower extrinsic value as a result of that. Anything that's deeper in the money, you're going to have a lower extrinsic value decay time or decay rate in that theta using that deeper in the money option. Okay, so here's an actual trade example. Let me just show you here that, and I'm showing you this one because this is a long ways from being a perfect trade. It didn't go exactly as we had expected. It was one of those trades that just looked really, really good. The stock had pulled back, found price support here in the trend, rallied back up, pulled back, held, and then at the time we bought it, okay, that was a nice tall white candle. All right, so we bought that trade. Well, by the end of the day, we were actually down in the position a tiny bit. So I just wanted to show you, this happens to everybody. I'm not trying to cherry pick anything. This is exactly what we did. Our stop loss was right below here. Okay. So the next day, the stock gaps up, okay, pushes through. And in that very first day move, we're up more than 20% on this trade. Okay. So I took 1/3 of my trade off. I scaled out, took 1/3 of my trade off, put money in the bank. All right. The market pulled back. Notice it did not trip our stop loss. Stayed above where our stop loss was and started back up. Here's the problem that most people have. They wait too long to get into the trade. And if you want to learn more about this, I'm happy to help you with this. It's what I do every single day. And this is a mistake I used to make all the time. I used to wait to get so much confirmation. I'd want that stock to continue moving up, prove it can break out. And I would end up buying it right at price resistance. And then the stock would pull back. And I would get stopped out because I would panic. I'm losing way too much money here. I'd panic, sell it right before the stock goes up. Now, I know anyone listening to me has done that. If you've traded at all, you've done that. In fact, you may almost have a complex like I did that every time you pull the trigger on a trade, someone has to be watching you because it almost immediately pulls back. That's a symptom of buying at resistance rather than buying at support. So there's a little bonus for you in this class here. So this pulled back and started up. Now it moved up again, right back up to here. I was up again more than 20% in the trade. Okay. So I took off another 1/3 of the position. So in two trades, I've already banked or taken off 2/3 of the trade with a 20% gain. So now I can really relax. I've made money in this trade. Now I can really relax and let the trade work. And so the trade goes sideways here for a few days. Don't have to worry about it, not concerned about it. But when it starts moving up from here, guess what I do? I take my stop loss that's been down here. This is now proof support once the buyers step in. Prove that it wants to go up. I move my stop loss up here. I protect my gains. All right. And then I let this trade work. Well, I ended up taking this trade off up here. And the last third of this trade was a 76% gain. So here's a trade that didn't really look that great. Didn't really look that good after the setup. Pulled back, did all of that stuff. But the way we managed that trade, the way we entered that trade, we had a great return. Now, we did that with an option. I think when we bought it, it was 74%, I think. It was a 74 delta option when we got into that trade. And when we finished that trade, our delta position was like 88, 89 deltas, something like that. Okay. So We did really good on that trade with a very simple position setup using the exact rules that I just talked about. Okay. Here's another trade. Now this trade has provided all kinds of trading opportunities for some time now, but the current trade that we are in, and we're actually in this trade right now, we bought that trade right here. Stock had been pulling back, gapped up, nice bullish candle, rested a couple days, and then follow through by the buyers. So we bought this here. Again, we bought an in the money option with 70 to 80 deltas. We're still in this trade as of right now, and currently we're up 55% on this position. Nothing fancy, simple, easy trade. Notice, by the way, there's no indicators on this chart. Just some simple trend following, reading the price action is pretty much how I make every trade decision I make for the market. I know it seems unreal in the world today where everyone's selling you some kind of a black box or super duper indicator package. I'm telling you, look at the opportunities in this trade, and it required no indicators to see them. Here's a great entry signal right here. Here's a fantastic entry signal right here. Here's a good entry signal after a pullback right here. Another very nice entry signal potential here. Another one here as we're breaking through this resistance up here. Now, if you held your stop losses under here, you wouldn't have been stopped out. Here's the next entry signal. And here's the new entry signal. This is easy stuff, guys. Just follow the price action. Don't predict it. Just follow a trending chart. It's really easy. And I wanted to show you here that this works very well even if you take a longer term position. This is a weekly chart in Microsoft. This is an actual right way options trade. We purchased the January 2019 options back here, excuse me, the 2018 options right here. Here's our entry. Nice candle here breaking out in December of 2016. All right. We bought the January 2019, gave us more than 400 days in the trade. We just let that trade move up the trend. Right up the trend it went. And as it went, we sold call options against it, collecting and bringing more money to the trade. We finally got called away up here at 72.5. On this trade, we got called away. Overall gain on the trade, 99%. Now, for me personally, that was a, depending on how many contracts you traded, okay? For anyone, this was a great trade. If you traded a single contract, let me show you, one contract trade, you would have made, you'd have made $850 plus on that trade. Single contract trade. You don't have to trade giant trades to be very successful if you use good, simple rules in the trade. Now, here again, when we bought this option, we actually bought an option that only had 68 deltas. Okay, but it was a January 2018, had 400 days to expiration. So here again, we still stayed really close with that rule. We gave just a few points up here to get an option that gave us a really good trade. By the time we were up in here, we were way up in delta on those options. Okay. Very simple, very easy trade to make. We do this. It's called a fig leaf trade if you're interested in using a leap option, selling covered calls against it. So again, following those rules, staying consistent. Now let me just take a moment to say that consistency is by far more important than being a hero. Being an effective trader has nothing to do with being right. It has everything to do with being consistent. We want consistency, right? We all want to make a consistent amount of money. We want that consistency to continue to grow our account. So we want to add consistency to our trading. So with that in mind, I've given this away before. I'm going to give it away again to anyone who watches this video. I have it's a short ebook, and only like 14 pages long, but it's full of charts, full of good information here. And in that ebook, I'm going to give you a strategy that I use to make consistent profits. So again, I've been trading more than 12 years full time, and been able to support my family with that. If you want to learn a very simple way of doing it, please download this ebook. Okay. Now you're going to find the links for this in the description of the video. Okay. So you can download this ebook. Now inside that ebook, there's some additional links, and I want to point those out here right now. Not only do you get the ebook, you get, I use TC2000 for my charts, but I give you an easy scan code, okay, that will help you build a qualified stock list, a list to work from rather than chasing around stocks all the time, a qualified stock list. And I give you the how-to in the book, and also give you the scan code. Now feel free to reverse engineer that to any platform. It really isn't that hard to do. And also feel free to change it up. Just because this is what I do, it may not be exactly what you want or you need, but I'm telling you it does work consistently. Okay. Also in here, there's an indicator that I talk about. It's called volatility stop indicator. I give you the whole setup, everything that I do, and I give you the code. I show you, there's a PDF on how to set it up in TC2000. There's a PDF on how to set it up in the Thinkorswim charts. So with the programming code, so you can use this indicator in both of them. It's helped so many people. I can't even begin to tell you how many people it's helped. I mean, I coach people from all over the world, and folks are just doing incredible things. I've taken losing traders with win-loss ratios of around, they lose, okay, they only win about 40% of the time, 35 and 40% of the time, and in a very short period of time, and I'm talking a short period of time, 30 to 60 days, they've become a winning trader between 60 and 70% winning trades to their 30% losing trades, just by doing some very simple things, small tweaks to get you there. Now, also in that link, nothing fancy here, is I have a series of videos on YouTube that support this book, okay? And in the book, there's the link to, start you out in that series of videos. Right now, there's just 5. That's going to continue to grow. But there are 5 20-minute videos there to support this setup and show you every step of the way how to walk through that position, how to set this up so you can start doing a better job in your trading. So I hope you guys found this effective. I hope you find that if you apply just some simple rules, some very simple rules, you will see a result change in your trading by being a little bit more dedicated here to your position. Avoid those amateur mistakes of buying those out of the money options with very low probability, options that have great big bid-ask spreads because we didn't take a look at implied volatility. We do the right things every single time. We follow a plan and a set of rules, and you will see improved results. So everyone, thank you very much for stopping in. Make sure you get your free ebook, and and I will, how did I do that? Make sure you get your free ebook on the website, and I will see everyone in the next video, okay? And by the way, if you guys have any ideas, anything that you'd like me to cover, I'd be happy to do that. Just feel free to send me a comment on this video, or click that like button too. I would really appreciate that. All right, everyone, take care. Have a good one. Wish you great profits, and I'll talk to you all soon.